Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for November 23rd, 2020. Please see our disclaimer for important information. Well, first of all, happy Thanksgiving to all of you in this week in which amidst this year that has been just absolutely crazy. This is one time that even though a lot of us can't be with some of the ones that we love the most, that we still can take stock and be thankful for what we have and what we can certainly hope for next year and beyond. But there's been quite a bit of noise in the markets over the last couple of weeks. We've seen a lot of positive aspects being focused on, and there are other negative aspects out there too. But we'll talk about all of that kind of in lockstep here. But kind of I'd say that dispersion is kind of increasing between what we see as the near-term risks of rising virus cases and the potential for economic lockdowns. And that's kind of offset by these long-term better growth prospects, which we clearly see out there on the horizon. But right now, the market's kind of focused on what they feel are the good things and not focusing as much on the bad. But I'd say that I do have some concern that the economy could hit some road bumps over the coming months, especially with the lack of visibility on this economic fiscal relief package, which continues to be stalled in Congress. But we're going to have to put up with some kind of difficult winter months and before the pandemic vaccine is available. We're going to have some kind of mixed economic data. We're already seeing retail sales beginning to soften. And there's some other things afoot, but I think what that does amidst this positive influence on the equity markets is it kind of sets a stage for some near-term risks and maybe some pullbacks, but I do think the longer term is fairly positive for the investment markets. So just kind of looking at what happened last week, the Dow was up down 0.7%. The S&P was down 0.8%. NASDAQ was up just slightly, and the Russell was up 2.4%. So, and we continue, as I said on the outset, that we have good news out there that the market's focusing on, and that has a lot to do with the vaccine. So not only do we had the initial announcement from Pfizer, we had a follow-on announcement by Moderna, and then now we've got AstraZeneca, which said that their vaccine was efficacious. And so there's a lot of enthusiasm around that, but we had some mixed results as well. So retail sales were fairly tepid, as I said, and I think some of the progress that we've made in retail sales has kind of petered out a little bit. Jobless claims actually rose when they've been on a downward trend. And then, even though some of the regional Federal Reserve indices, like the Philly Fed and the Empire State Manufacturing Index, even though they're positive and they show this clear bounce back from earlier this year, they nevertheless disappointed in the most recent readings. And so, and again, we've got plenty of virus news to share. If you go to our charts of the week, you can see the first few charts are always, I shouldn't say always, but lately they've been dedicated to coronavirus trends and hospitalization rates and things like that. So, but obviously we had a 73% increase in cases. We're up to 187,000. We had almost 2,000 deaths on November 19th, which is kind of the last day of this reading. But So I mean, we've got that to deal with, and that's not going to go away anytime soon, especially with cooler weather, more indoor activity, and even those who are willing to, gather in large groups for family gatherings for the holidays, I think pose a risk as well. But, on the positive side, we've got a lot of bullishness in the markets. In fact, we've seen a tremendous inflow net bullish sentiment as measured by the American Association of Individual Investors, or AAII, went from kind of a neutral state, and it went to sharply bullish over the past several weeks. And this is one reason why I feel like we've made such a transition from neutral to extreme bullishness that I think that we're probably ripe for a pullback here at some point in the markets. But we see, in a survey of portfolio managers by Bank of America, they're expecting strongest profit performance in 20 years, and equity allocations are at their greatest overweight positions in at least 2 years, and they've cut cash positions tremendously. And then you've seen other signs of kind of froth in the markets. You've got Bitcoin, which is crazy. It's well over 18,000 now, and junk bonds. We have narrowing credit spreads that are less than 5%, and this is just you think about all of the potential stress in the market for bonds. It's just hard to believe that we've had so much spread compression in high yield bonds, and we've got money that's actually now flowing out of gold and into risk assets. But just looking at the markets in general, the S&P 500 for the year is up about 10%. Dow Jones is up about 2.5%. Nasdaq's up 32%, and then the international indices remain fairly mixed. As we've talked about several times over the last several weeks, we've got a fairly sustained rise in cases over in Europe, and we've got some very noticeable lockdowns and some kind of draconian measures that some countries and some jurisdictions are taking to kind of try to slow the spread. But Europe for the year is down about 2.3%, and emerging markets are up about 8.5%. So they've done extremely well and still represent really strong value out there. In bond markets are up about 7.3 in terms of the Barclays aggregate, which exceeds high yield, which is about 4.4. And as I've said, we've had high yield spreads compress, and that's translated into fairly strong performance for the high yield bond sector. Real estate is troubled, but not as much as it was. Energy is still fairly has experienced a lot of pain, although here lately we've seen much better performance out of the energy sector. In fact, WTI crude is trading around, or West Texas Intermediate crude is trading around $42 a barrel, and that's up almost 18% for the month, although still down 31% for the year. So, and gold, as I've mentioned, still just wants to hang around about that 1870 level. We've seen it as high as 1900. It's up about 23% for the year. And the U.S. dollar was down again next week and is down about 4 percentage points for the year. So the 10-year Treasury, we continue to monitor this. We've had a big, relatively big spike from a range of that 55 to kind of 75 basis point level. It's trading at 82 basis points on the yield right now for the 10-year. That's still down over a percentage point from the beginning of the year, but again, it's below some of those near 1% levels that we saw kind of once this market really kind of picked back up after September. And high yield is still yielding about 4.8, 30-year Treasury about 1.5%. So, I mean, at least we've got some noticeable steepening, even though if the curve itself is still fairly low. But just looking at the puts and takes, we've got mentioned bullish sentiment, and we've mentioned high yield credit spreads, and we've mentioned what the market's been focusing on over the last several weeks, which has been really positive. But I think more economic pain is probably on the horizon. So I think the news gets bad or gets worse before it gets better. So, obviously we've got the risk of having our healthcare systems on a regional basis being overwhelmed. We obviously care a lot about the stress on the healthcare system with rising cases, but As you'll notice also in the 7-day moving average for the charts of the week, that first chart, which we show the COVID tracker, that the mortality rate for coronavirus continues to go down, and certainly goes down tremendously relative to new cases, which is very positive. Just other things to kind of talk about. Manufacturing is held up reasonably well. It was above expectations in the October reading. And we know that we've talked ad nauseum about the fiscal stimulus bill that just continues to be hung up. And retail sales for the month of October were only up 0.3%, which is well below expectations. And it's beginning to give some cause for concern that the lack of stimulus and all of the statistics that kind of show the weakening of some of the lower socioeconomic levels, which have really supported consumer spending during the pandemic when they were receiving all of that fiscal stimulus. Now that that's going away, and a lot of these unemployment insurance programs, the pandemic, the PUA, the pandemic unemployment dollars that have been distributed, those programs are really set to terminate at the end of next month. So there's a lot of speculation on what that's going to do. In fact, we've got other, I'm not going to say that this is tied to politics directly, but it certainly has some implications. But Treasury Secretary Mnuchin has requested, and it appears that the Fed is going to terminate some of their lending programs by the end of the year. And so that obviously gives the Fed less seed corn if for some reason we slip into kind of that second recession, or we get some delays in the vaccine, et cetera. But we've talked about corporate earnings holding up pretty well, and we've talked about the labor market kind of looking like it's doing okay, all things considered, although we're well below where we were. I would say that beyond, if you look beyond retail sales, if you look beyond, some of the stress on small business, if you look beyond maybe some of the noise in the data that I expect to see on economic data over the next couple of months, the outlook is actually brighter once you get past that. I think, when we get into the first half of 2021, we'll have stronger economic mobility, and we know that we've got an accommodative Fed, even if that increases inflation expectations and interest rates. But if we can survive a lot of additional damage to the service sector that we've already seen, beyond that which we've already seen year to date, I think the picture certainly for the second half of 2021 and into 2022 looks a lot better. But just looking at other items that kind of caught my eye during this last week. Let's see. Looking at the risk of more lockdowns. Who would that impact? I think there's some research that shows that small caps could be impacted, so might temper the enthusiasm that is suddenly kind of filtered into the small cap sector. But I think by and large, the market is going to try to look through the bad news and try to kind of read in more optimism in the future, and I do see that optimism, as I've said. And let's see. Yeah, and so something else I found was pretty interesting is that according to the Wall Street Journal, somewhere around 300 companies that received as much as $500 million in pandemic-related government loans have filed for bankruptcy. This comes by way of Sandy Leeds in his weekly commentary. I thought this was pretty amazing. And those 300 companies employed 23,400 workers, and they received each of the companies received somewhere, well, I should say collectively they received anywhere between $228 and $509 million apiece, and not collectively, excuse me. And So I mean, we've got a lot of, I think that's the one thing in a fiscal stimulus bill that we want to avoid is propping up zombie companies or those companies that are not set to fare very well. But I think we continue to run the risk of having politics play a part in this stimulus bill, and I think it's clear that we need it. Right now, I think the best guess is that we probably don't get it before the inauguration, or we might get something that now that I think maybe some of the Republican senators feel a little bit unshackled, especially as they're trying to posture for the January 5th runoff in Georgia, which will determine whether the Republicans maintain their majority in the Senate. But they might push for something that gives a little bit of juice, and then perhaps when President Biden takes over, we get some more stimulus there. But I think right now that's really almost too tough to call. But we still have stress in the long-term unemployed. We've got an increase in those that have been unemployed for 26 weeks, and those folks are going to need some help because of all those programs that are rolling off. And I can't underscore that enough. We talk about it every week in our charts of the week, and I try to include some charts that kind of reference that issue, and I really don't see that getting better, and the market's not filtering that in yet, and we're not getting a lot of buzz in the press about it, but it's definitely something that's there, and so we can ill afford to not have some stimulus that helps those people. But other than that, the only other thing that I probably want to say, is just how strong home sales are lately in the real estate market. Residential real estate's been phenomenal. Existing home sales hit a 14-year high, and that's obviously driven in large part because we've had these low interest rates. It's the fifth straight monthly increase, and October sales were almost 27% higher on a year-over-year basis, and median home prices were up about 16% year-over-year. And the interesting thing there is that amidst some of the stress in the small business sector and with incomes overall being pinched a little bit, perhaps because of all of the stress in the small business sector, those median home prices really make housing affordability much more tough. But despite that, we still have almost interim lows in inventory out there, so it's definitely a seller's market if you're selling. So it would be a good time if you're interested in downsizing to actually to take advantage of that. But so that's there's a lot more obviously we could talk about. We've talked a little bit about the markets and where we think they're going to be. I think we've got to get through the next couple of months. I think they're going to be difficult months. I think from a coronavirus and pandemic standpoint, we're set to see more bad news and some curbs in our freedoms, if you will. But it's all for a long-term gain, and I think that the visibility once we get past that and certainly into the second half of next year is actually fairly positive. So if we can weather a little bit of volatility here over the next couple of months in the markets, which will be reflective of that choppy economic data that I expect that we'll see, we will come out ahead. And I think there are going to be opportunities to find value. I think we're looking at several things on an investment side, perhaps setting ourselves up for a pretty reasonable rebalancing, kind of preparing ourselves for that eventual updraft, but still keeping probably a little bit of portfolio insurance in just to guard against the downside, given that the market's really kind of almost gotten ahead of itself a little bit. I still think there's value in overseas markets. It's really tough to find a catalyst there now. And we've also seen a lot of recent enthusiasm in small caps. And again, we've talked about some of the risks of small caps if there is a kind of a continued wave and a kind of a strong economic dip. But I think overall, small caps have not participated nearly as much in some of this in some of this rally that we've seen in other larger cap names. So that's an area that we want to focus on. And then on fixed income, we're still focused on credit quality. We're still focused on staying somewhat short. We've seen such a strong move in interest rates that it's very hard to kind of think about the opportunities in capital appreciation from here in fixed income, and yield is very tough as well. But but there are things in other type of products such as structured notes that can get us incremental yield that we couldn't find in the bond market itself. But in any case, just a few comments there, which will conclude our conversation today. Would like to offer all of you a very healthy and safe and joyous Thanksgiving week. Please enjoy yourself at the dinner table, wherever you might be and whoever you might be with, and hope the dinner is wonderful. And we look forward to visiting with you again next week. That will do it today. So please feel free to reach out to us at the information provided. We'd love to hear from you. Be safe, and we'll talk to you again soon.